What's going on, y'all? Happy Monday and welcome to another edition of Weeds Weekly, where we're going to break down what happened this past week with regards to the mortgage space and data and what the Fed is thinking. I'm going to talk about this upcoming week and what a big week we have. It is finally here. The Fed is going to reduce the Fed funds rate on Wednesday. How much? We'll dive into that as well. The other thing we're going to talk about credit optimization and why everybody should be doing it. And if your lender is not discussing it with you and your clients, you're missing out because it's only hurting your business and it's not helping the client. And then I'm going to get into some predictions. We're coming up on Q4. We got a lot of things going on. So I think it's, hey, let's put our money where our mouth is. And I'm going to give some Q4 predictions of what I think is going to transpire as it pertains to rates, data, and so on and so forth. So this past week, look, the biggest thing that we saw was everybody's anticipation of this week. But a few things did stand out. So number one, what I saw was, and I referred to it as the Empire Strikes Back. Look, we all go through life. Everything's moving along great, and then there's a slight bump in the road. And that's exactly what Core CPI presented this past week. And while it didn't really affect interest rates too much, make no mistake about it, it is something that the Fed saw. The Core CPI actually ticked up 0.1% for the first time in about 5 months. So yeah, I get all the media, I get all the headlines. Wow, inflation's tame, inflation's this. Yeah, but it's really easy for inflation to be tame when you've had these higher interest rates, the Fed funds rate at this level for now about 16 months, and you're coming from an inflationary standpoint of almost near 9%. I mean, let's not kid ourselves, right? But the fact that month over month, we're still at about 2.6%, 2.5%, it's still a little bit higher than the Fed would like to see, although coming down. So I think what they're going to do is they're going to look at it as just a little bump in the road, but make no mistake, it is definitely something that they noticed. The other thing is, by midweek, the market just looked a little bit tired. We've been rallying lately. We talk about it all the time. The market is forward thinking. Everyone that's sitting on the sidelines believing that interest rates are going to plummet, the market has already factored in the Fed funds rate cut this week. Now, there's a lot of uncertainty surrounding it with regards to how much, and we'll dive into that in a second. But make no mistake about it, the market is forward thinking, so a lot of that is already priced into the market. So by midweek, we looked a little bit tired. The best news of last week is we hit 52-week lows with interest rates. Yes, they were a little bit volatile, and I don't mean highly volatile from a standpoint of big spikes and big decreases, but the lowest rates are not there every day. So that's why it's always good to be in constant contact with your lender, with your situation, so that you can make the best educated decisions. So now let's talk about this week, and we are finally here, right? We've been talking about it since I've been cutting these videos for now about 16 months. We are going to get a Fed funds rate cut. Hallelujah. So, right, looks like things, better days are ahead. Let's just say that. We're going to see, everything from big ticket items. We're seeing interest rate drops. We're going to see debt for clients decrease, right? Because that's all of that is tied to that Fed funds rate, which is really critical. Now, what is the Fed going to do? Are they going to do a quarter point or are they going to do a half point? When I look at and analyze the data from a labor perspective, and we had that big dip in the non-farm payrolls and we've had corrections to the labor market, I just don't believe with inflation coming down that the Fed really needs to get ahead of itself and do a knee-jerk reaction of a half a point. I think they'd be better pressed to do a quarter. I think then right after the election, they'd be better pressed to do another quarter. And then I think maybe by the end of the year, if they felt like it, they could do a half. However, what do I think is going to happen? And as I've mentioned before, I think every level of government is political in some nature. They are going to do a half a point. I'm going to make that prediction. I don't think they should, but I think we are going to see the unexpected. And the funny thing that I saw was last week on Wednesday and Thursday morning, we were at about a 13% chance of that happening. By Friday, we were at 50-50. And as I'm sitting here now on Monday morning, we're now at about a 57-59% chance that people believe we're going to get that half a point. So the market is already starting to bake that in, right? So you definitely, my best advice is for you to pick up the phone, call your clients, make sure they are in a position with their mortgage professionals that their application is in and they can lock rates, because it could happen quickly that we get a knee jerk of the interpretation of what the Fed says. We get lower rates only to see them go back up. So you want to make sure that you have that message for your clients. The other thing is, we talked about it, it's a coin toss, right? So how lucky are you feeling with this Fed funds rate cut? And the other thing that the Fed's going to get an inside look at is retail sales. They come out tomorrow morning. The consumer equates for 2/3 of the GDP. It's going to be something that at least the Fed is going to have an opportunity to digest, to make sure that the economy is not falling off a cliff. I think that may weigh heavily into their decision making. If the consumer shows really strong retail sales, they may be inclined to only go to a quarter. If we come in right at forecast, again, I think they're going to get political in nature, and I think we're going to see that 0.5 point. All right. The other thing that we're going to see also, and this is really critical, it's one of the 4 times it comes out, we are going to see the Fed's dot plot. The dot plot is where all Fed members indicate where they believe the Fed funds rate will be as they approach each monetary cycle and each Fed policy change going out for the next year. So it's going to be really interesting to see that dynamic charted out as well, to see where those Fed members fall and what changes they have made in their thought process of where they believe things are going to be. And I think that is also going to affect rates because, again, traders in markets are forward thinking. So that is very critical, something that I haven't heard a lot of people talk about, but it's going to be huge when that data comes out and the Fed makes that announcement on Wednesday. So heads up for that. So what's credit optimization? Credit optimization has really been around for quite some time. And unfortunately, a lot of people do not utilize it. And I say it all the time. I think that any person that's looking to purchase a home should be talking to their mortgage professional as soon as possible. What credit optimization, it's very different than credit repair. In credit repair, you got to go through a very diligent process of letters, back and forth with the credit bureaus and so on and so forth. Credit optimization is basically where it is developed through AI and through some very sophisticated systems where I can do what is called, for lack of a better term, a what if scenario. So I can take somebody's file, I can plug it into an optimization, and it will tell me within seconds what actions that client could take to possibly push their credit score from anywhere from 20 to potentially 50 points higher or even greater than that. It really just depends. And it can range from a variety of things. It could mean maybe changing your usage on your credit card debt, right? Maybe moving it around, restructuring it, maybe paying off some short debt that you have that maybe is just not being realized. Often what we see on credit reports is somebody has something that's reporting and they have a zero balance. They're paying it off every month, but based on when the bureaus are pulling that data from that lender, it's showing as a balance and it's skewing your credit report. And my point is, the stats have proven out that over 70% of borrowers, and I don't care if you got great credit, poor credit, you're in the middle, you're at a 640, you're at a 7, it does not matter. 70% of the people out there can benefit from this. And what does it mean for you as a real estate agent? Number one, you're doing the right thing for your client by advising them to talk to a lender like myself that can offer these services and is educated on how it works. But number two, typically what it does by increasing that credit score, it is going to increase that client's purchasing power. It's probably going to possibly put them in the home that they want to purchase as opposed to the home that they're settling for based on their payment, right? Because a better credit score is going to mean a lower interest rate. And if I look at it really quick, just running some numbers, if I take somebody with an initial score of a 640, looking to borrow $360,000 with a 90% LTV, by utilizing the credit optimization, let's assume we can increase that score to a 680. That is going to reduce their rate, right, or their basis on their rates by 0.65, which is going to equate to about $158 a month in principal and interest reduction, as well as $131 in monthly PMI. That is huge. I mean, you're talking that's $289 in savings of potential purchasing power to go out and buy the house that they really want to buy. So if your lender is not using credit optimization and after hearing this, you want to have a further discussion, I think we should absolutely jump on a call, meet for a coffee or whatever. And if you're a client and you're listening to this, you need to be talking to your mortgage professional sooner rather than later. This is going to be a game changer going forward. Everybody should be utilizing credit optimization before they ink the bottom line and get the interest rates and the costs associated with their loan. It's going to save clients thousands. And I'm doing it all the time. So that's that. As far as predictions, let's dive into it really quick. And here's what I think is going to happen. As I've already alluded to, I think the Fed's going to do a half a point tomorrow, or Wednesday, I should say. They're going to give that half a point. Like I've been saying since the beginning, I think after the election, when all the dust settles, I think the Fed is not going to do anything at the November meeting. November 5th is the election. I think November 8th is their announcement. And I think they pause to digest the results of that election, because I think there's still going to be some, hey, we got to count votes and so on and so on. I think it's going to get a little bit gray potentially. And I think there's a potential for we don't know come November 8th. And I think the Fed's going to pause. I think based then on data, we are going to then get a quarter point in December. We may get a half a point, but typically what happens is during the holidays, consumer spending goes up. I think you're going to see hires, although short-term hires for the holidays obviously happens all the time. I think that's going to happen once again. I think the economy could potentially look a little bit better than it should. And I think that's exactly what we're going to get from the Fed. So while everyone is screaming that we should get about a point, if not to a point and a half in reductions before the end of this year, I think we're going to land at about 3/4 of a point. And I think a half is coming on Wednesday. And I think another quarter based on today's data is coming in December. And then lastly, the other question I get all the time is how do these elections play? And I think we're seeing it across the board. As a lot of you know, I'm also a licensed broker up in the state of Michigan. And I think right now the election has a lot of buyers, has a lot of people in quicksand. I think on the selling side, I think you're seeing a very active market. I think people are educating themselves on what that house should go for, and they're making good decisions on how to list it, and they're working with their agents to do so. And I'm not seeing a plethora of sellers run to the marketplace, and that's really just a couple things, right? A, money is expensive still, make no mistake about it. And they locked in on those really low rates. We've talked about that before. How many people right now sitting in their house are under 4% on their interest rate? To now jump even to 6%, that's 2% more. That is a lot of money. So you're not going to see that big flux of sellers to the marketplace. But what I am seeing, and I know agents are seeing it because I've talked to a lot of them, and I'm seeing it as well. I see a lot of buyers that are interested, but they're trying to predict the market. And they're also just skittish due to this election. And to be honest with you, I think potentially the worst of the election is yet to come. I mean, we just had another assassination attempt over this weekend. We still have about 6 weeks to go here, 7 weeks to go. I just think it's going to get a little bit dicey, and I think it's going to keep a lot of transactions on the sideline. I've said it before. I've said it on my Thursday morning What's Brewing show. The month prior to an election, we typically see a 15% reduction in transactions. That's huge. That is a big number. Now, post-election, we see activity increase. We see typically prices go up 9 out of the last 11 presidential elections. But coming into this month right here, even after the Fed gets aggressive and political with their half a point, I think people are still going to be sitting on the sidelines, and it's going to take a lot of us just being educated on the marketplace and pointing out opportunities. The key word for the month of October, think opportunities. That's what we need to be talking about with our clients and our potential buyers that are out there. Is there's amazing opportunities right now that come post-election could evaporate. And I would just make that very clear, and that would be my biggest concern for Q4, where I think a lot of potential buyers are going to miss the boat trying to predict the market. All right, everybody, have a great week. Hey, it's reason to celebrate. We're getting a Fed funds rate cut. Rates are on the decline, and 2025 is almost here. We're going to get through this election cycle, and we're going to see both activity increase. We're going to see prices stabilize and go up, and we're going to be lining ourselves up for a very active and productive 2025. Everyone have a great week. If I could be of any help to you, don't hesitate to call, email, text, whatever. As usual, I'm always working. Have a great week. I'll talk to you all soon. Cheers.